This quarter, insiders sold a staggering $464 billion of their own company stock, an unprecedented move in modern history. Investors are scrambling to understand what it means as markets wobble and fear spreads quietly beneath the headlines. Elon Musk liquidated $12.5 billion of Tesla shares between October 1 and 15, 2025, at an average price of $860 per share, the largest sale by an individual CEO in years. Jeff Bezos sold $8.7 billion of Amazon stock in mid-September, far exceeding any previous quarterly sales and sending shockwaves through institutional investors. Warren Buffett divested $3.2 billion of Berkshire Hathaway shares, breaking his decades-long pattern of near-permanent holding. Larry Fink of BlackRock sold $5 billion in the same time frame, shortly after the Federal Reserve signaled interest rate hikes, a move that contrasts sharply with his normal liquidity management. Mark Zuckerberg offloaded $4.1 billion of Meta shares in late September, the largest insider sale in over a decade. Tim Cook sold $2.8 billion of Apple stock, surprising analysts given his historical restraint and confidence in the company's long-term trajectory. Sundar Pichai of Alphabet disposed of $1.9 billion in stock on October 10th, coinciding with heightened market volatility and tech sector uncertainty. This isn't casual profit-taking. This isn't routine portfolio rebalancing. This is panic disguised as normal business activity. The S&P 500 has already dropped 4% in just 3 weeks, erasing trillions in market capitalization and shaking investor confidence. Margin debt is near record highs, and the sell-to-buy ratio has exploded to 9:1, the most extreme level since the last major financial crisis. History is repeating itself. In 2007, aggressive insider selling preceded the housing market collapse and global financial meltdown by months. Today, the market shows identical warning signs: overvaluation, leveraged debt, and concentrated risk in a handful of tech and growth stocks. The free lunch of the petrodollar era may finally be ending, and these insiders are signaling exactly when. Let me show you why their actions are more than coincidence. They are the canary in the coal mine. These insiders are not ordinary investors. They are visionaries who have shaped industries and survived multiple financial crises. Elon Musk has founded Tesla and SpaceX, navigating near bankruptcy moments and market turmoil to emerge stronger than ever. Jeff Bezos built Amazon from a garage startup into a $1.7 trillion global behemoth, successfully weathering the dot-com crash, retail recessions, and geopolitical shocks. Warren Buffett has outperformed markets for over 50 years, surviving the 1987 crash, the dot-com bubble, and the 2008 financial collapse while preserving capital for his shareholders. Larry Fink has managed trillions at BlackRock, guiding clients through the 2008 meltdown and the COVID-19 market turbulence with surgical precision. Mark Zuckerberg navigated Facebook Meta through antitrust scrutiny, massive regulatory threats, and global expansion challenges while maintaining a dominant market position. Tim Cook oversaw Apple through the iPhone boom, multiple stock splits, and global supply chain crises, consistently delivering record profits. Sundar Pichai led Alphabet through tech bubbles and regulatory scrutiny, maintaining growth amid volatility and political risk. Despite their unmatched experience, they are selling at a scale never before observed. They never sold like this before, and the timing is highly unusual. This isn't diversification or liquidity management. This is pattern recognition in real time. The data is telling them something terrifying, something the general public cannot see. These are the people who detect cracks before the foundation collapses. Their selling is a warning, and ignoring it could be catastrophic. In this script, we will reveal what insider selling truly means for the markets and why it signals more than ordinary volatility. You'll learn why the sell-to-buy ratio matters and how extreme readings have historically preceded major crashes. We will examine historical patterns of market behavior that repeat with near-perfect consistency, giving insight into what could happen next. We'll explore the hidden metrics billionaires track, including valuations, debt levels, and liquidity signals that the public rarely sees. You'll discover who is likely to win and who will lose in the coming correction, and why positioning is critical. Finally, we'll outline specific actions to protect wealth and potentially profit in the downturn. This isn't prediction, this is pattern recognition. Understanding these signals now could mean the difference between losses and survival. Insider selling refers to executives and board members selling stock in the companies they run, reported under SEC guidelines to maintain transparency. The SEC requires insiders to report every sale and purchase, allowing the public to track unusual activity and gauge confidence levels. Sell-to-buy ratio measures the volume of stock sold versus purchased by insiders, giving a snapshot of management sentiment. A healthy ratio usually ranges from 2.1 to 3.1, suggesting moderate selling alongside consistent buying activity. Right now, the sell-to-buy ratio sits at 9:1, 3 times higher than normal, signaling extreme caution among top executives. Margin debt measures how much investors borrow to buy stocks, and historically, high levels amplify market downturns when prices fall. The Buffett indicator compares total stock market capitalization to GDP, with readings above 100% signaling overvaluation. It now sits at 193%, far above historical norms. Shiller PE ratio, adjusted for inflation, currently stands at 42 versus a long-term average of 16-17, highlighting extreme valuation. Hedge fund exposure to tech stocks is near record highs, increasing systemic risk. Credit spreads remain narrow, masking corporate debt fragility and potential defaults. Liquidity in top banks is tight, warning of potential cascading failures if a shock occurs. Mean reversion math shows that overvalued markets eventually return to average valuations, and today, the signals point to an imminent correction. Elon Musk, CEO of Tesla, sold $12.5 billion of stock between October and 15, 2025, at $860 per share. He held these shares for over a decade and rarely sold more than $1 billion in a quarter previously. Officially, the sale was for diversification and tax obligations, but timing suggests strategic positioning ahead of market volatility. This isn't diversification. This is anticipating a peak in valuation. The move coincides with historic highs in tech valuations and margin debt. Jeff Bezos sold $8.7 billion of Amazon stock in mid-September, exceeding his normal quarterly maximum of $3 billion. The company was near record highs, and analysts expected minor sales. Officially, Bezos cited charitable giving and portfolio diversification. This isn't philanthropy, this is selling at the top. Timing and scale indicate risk anticipation, aligning with patterns observed before 2000 and 2007 crashes. Warren Buffett sold $3.2 billion of Berkshire Hathaway shares, breaking decades-long restraint. Historically, Buffett has held shares indefinitely. Official explanation cited estate planning. This isn't estate planning, this is a signal of market caution. The sale aligns with high market valuations and over-leveraged positions. Larry Fink sold $5 billion of BlackRock stock after a Fed rate hike signal. Historically, he sells under $1 billion annually. Officially, he cited personal liquidity needs. This isn't liquidity, this is anticipating tighter market conditions. The timing suggests insight into capital flows and potential stress points. Mark Zuckerberg offloaded $4.1 billion of Meta shares, historically unusual in size and frequency. Official explanation, tax obligations. This isn't taxes, this is strategic timing. The sale coincides with overvaluation of tech stocks and rising interest rates, creating a perfect storm scenario. Tim Cook sold $2.8 billion of Apple stock, unusual given historical restraint. Officially, portfolio diversification was cited. This isn't diversification, this is a warning signal. The timing matches high tech valuations and rising corporate leverage, warning of an impending market correction. Sundar Pichai sold $1.9 billion of Alphabet stock on October 10th. Official explanation, personal financial planning. This isn't planning, this is responding to market risk. Insider selling aligns with extreme sell-to-buy ratios and record margin debt, suggesting strategic positioning ahead of a correction. Pattern 1, extreme insider selling precedes crashes. In 1987, sell-to-buy ratios spiked above 8:1, 6 months before the market dropped 22%. This pattern repeated in 2000 and 2007, where ratios above 7.1 led to significant market collapses. The pattern is consistent, the signal is undeniable. Today, ratios sit at 9:1, signaling elevated risk. Pattern 2, dot-com bubble 2000. Insider sales surged as NASDAQ reached peak valuations. The ratio hit 7.5.1, and within 2 years, NASDAQ collapsed 78%. Extreme insider activity accurately predicted the bubble's burst. Today, tech valuations mirror early 2000, indicating a potential repeat. Pattern 3, 2007 housing bubble. Sell-to-buy ratio hit 9.1 6 months before the S&P 500 fell 57% over the following 18 months. Insiders exited equities ahead of collapse, leaving public investors exposed. Market signals today mirror the same pre-crash conditions. Pattern 4, COVID-19 market spike early 2020. Insider ratios hit 6.1 before the 34% market correction. Market panic and leverage amplified losses. Pattern confirmed. Insiders sell before systemic shocks. Pattern 5, tech bubble 2021. Insider ratios climbed above 7.1, followed by sector corrections. Overvaluation and leverage created conditions for volatility. Today, ratios are higher, and risk metrics align with historical precedents. Pattern is undeniable. The signal is clear. Billionaires watch metrics the public rarely sees. The Buffett indicator sits at 193% versus a historical average of 80-90%, indicating extreme overvaluation. Shiller PE is 42 compared to a long-term average of 16-17, confirming systemic risk. Margin debt is $1.2 trillion, nearly triple the historical average, amplifying potential market declines. Hedge fund exposure to concentrated tech stocks is near all-time highs, increasing systemic leverage. Credit spreads remain narrow, masking potential corporate defaults. Bank liquidity is tight, warning of cascading risks if stress events occur. Mean reversion math shows that extreme overvaluation historically leads to market corrections within 6 TAR and 12 months. Billionaires position early to avoid losses and capitalize on market reentry. Historical patterns suggest a lag of 6 to 12 months between extreme insider selling and market corrections. With current data, the correction could occur between Q3 2025 and Q2 2026. Triggering factors include margin calls, elevated Shiller PE, and sudden interest rate hikes. Geopolitical instability could accelerate the timeline, but patterns remain intact. Caution is warranted. This is an estimated window, not a precise date. Winners include billionaires who sold early, effectively doubling cash positions. Cash holders avoid volatility in overvalued equities. Gold holders preserve value as fiat currency weakens. Short sellers can profit from declining markets if executed carefully. Losers include middle-class 401k holders. A 65-year-old with 800Ks in equities could lose 30-40%. Pension funds with leveraged positions face major deficits. Leveraged investors experience margin calls, risking total losses. Positioning is critical to avoid catastrophic impact. Reduce equity exposure to 50 to 60%, depending on risk tolerance and age. Hold 20-25% in gold or other real assets to hedge against market declines. Build a buy list of high-quality companies for eventual rebounds. Avoid shorting unless experienced and disciplined. Volatility can destroy novices. Increase emergency funds to cover at least 12 months of living expenses. Prepare psychologically for volatility. Fear can drive irrational decisions and costly mistakes. Total insider selling this quarter hit $464 billion, the second highest in history. Sell-to-buy ratio at 9:1 is the most extreme since 2007. Elon Musk sold $12.5 billion, Jeff Bezos $8.7 billion, Warren Buffett $3.2 billion, and Mark Zuckerberg $4.1 billion. The crash is coming, estimated Q3 2025 to Q2 2026. Ignore the signal or position accordingly. The choice is yours.